Before we break down the different indexing options inside a fixed indexed annuity, there's a guiding principle that frames everything. Professionals don't allocate 100% to a single index. They blend strategies, traditional exposure, multi-asset smoothing, volatility control, and sometimes multi-year structures, and they adjust the weights based on the client's objectives. And because most FIAs allow reallocations at each reset cycle, you're not trying to find the perfect index. You're learning how each index behaves and how to construct a portfolio of rule sets inside the FIA. With that context, let's start with the core mechanism that drives everything: the options budget. Each year, the insurance company receives a fixed option budget, the amount available to purchase options tied to whichever index you select. This budget does not depend on the index you choose. It comes from the interest the insurer earns on its general account bonds. Here's why this matters. Some indices are inexpensive to hedge. Some are very expensive. That single difference determines whether the FIA can offer a cap, a participation rate, a spread, or, in growth-focused allocations, multiple times the index's movement through high participation multipliers. Understanding hedging cost is foundational to choosing the right index mix. Why volatility matters more than raw returns. Most people mistakenly evaluate an FIA index based on historical returns. But inside an annuity, volatility is the real driver of hedging cost. Two indices with similar long-term returns can have drastically different hedging prices due to volatility. Lower volatility, which means cheaper hedging, which means more of the option budget can be used to give you greater index exposure through participation multipliers. Higher volatility, which means more expensive hedging, which means the annuity must scale back exposure using caps or lower participation. This is why volatility-controlled and multi-asset indices often show participation rates of 150%, 200%, 250%, and even 300% plus, depending on the reset period and structure. These aren't high-return indices. They are option-efficient indices, which allows the annuity to amplify their movement more effectively. Why traditional indices aren't automatically better. The S&P 500 is familiar, but familiarity doesn't equal suitability inside an FIA. Because the S&P 500 has high volatility, it is expensive to hedge annually. This is why one-year S&P strategies often have modest participation rates or cap structures, unless paired with multi-year resets or strategy charges. But when you give a traditional index a longer reset cycle, or combine it with a strategy charge that expands the option budget, it can become a powerful growth component. Professionals don't view the S&P as universally strong or weak. They view it as a specialized tool, excellent in certain structures, inefficient in others. Why engineered indices actually exist. Engineered indices often target volatility levels like 5%, 6%, or 8%, and this is widely misunderstood. A volatility target is not a return target. It is a deliberate risk constraint that stabilizes hedging cost. This does not mean engineered indices are designed to deliver low returns. It means they are designed to deliver stable, option-efficient movement, which the FIA can then amplify through high participation. When these smoother patterns are paired with elevated participation multipliers, sometimes exceeding 100%, 200%, or even 300%, depending on structure, the credited interest can become far more competitive than people assume when they first hear the term engineered index. The purpose isn't to outperform the stock market in raw terms. The purpose is to create stable volatility and predictable hedging, so the FIA can maximize efficiency in its crediting formula. The volatility cost premium. The real constraint in an FIA isn't the market itself. It's the cost of purchasing the option that tracks the index's movement. Higher volatility equals higher hedging cost. Higher hedging cost equals lower caps or lower participation. Lower volatility equals lower hedging cost. Lower hedging cost equals the annuity can buy more exposure. Engineered indices maintain predictable volatility, which stabilizes hedging cost and supports consistently strong participation terms even when markets are turbulent. Traditional indices fluctuate more dramatically in volatility and cost, which is why their annual reset terms swing year to year. This volatility cost premium is one of the reasons professionals favor a blended allocation strategy. Why multi-year resets can boost potential. Multi-year point-to-point crediting gives the annuity a larger option budget because the insurer has more time to structure the hedge. More time, which means more budget, which means more powerful options. This is why multi-year strategies often offer significantly higher participation multipliers, greater long-term potential, better alignment with traditional indices, synergy with strategy charges in growth-oriented allocations. Multi-year isn't riskier. It simply operates on a different time horizon and is best suited for clients prioritizing growth over frequent lock-ins. The real environment you're choosing indexes in. This is the framework for selecting the right indexing strategy. You're not choosing based on past returns or index popularity. You're choosing based on how each index interacts with the FIAs. Option budget, volatility profile, hedging cost, reset period, participation efficiency, and relative stability. Once you understand these constraints, you can construct blends that align with your goals, whether consistency, long-term potential, or a balanced rule-set portfolio. This is the lens professionals use, and it's the foundation for everything we'll build on in the next sections. The two indexing lanes, traditional versus engineered, and when to use each. Now that you understand the environment FIA indices operate in, the option budget, volatility constraints, and how exposure is amplified, the next step is choosing the indexing philosophy that aligns with your goals. There are two primary lanes, traditional indexing and engineered indexing. Both can be valuable, both can be strategically important, and both have specific roles inside a professional allocation. Neither is better, and neither is safer. They simply behave differently inside the FIA's mechanics. Let's break down each lane and the strategic context where it fits. Traditional market-linked indexing. Traditional indexing includes market benchmarks like the S&P 500, the NASDAQ 100, the Dow, and sector or thematic indices. These are direct representations of market movement. No smoothing, no volatility targeting, no rule overlays. How traditional indexing behaves inside an FIA. Traditional indices tend to have higher volatility, higher hedging cost, stronger performance clusters, and significant dispersion from year to year. In a normal investment environment, volatility can create opportunity. But inside an FIA, volatility is the primary reason traditional indices often have lower annual participation rates, more frequent zero-credit years, or cap structures on short reset cycles. Where traditional indexing shines, when you increase the option budget through multi-year reset periods or strategy charges. Traditional indices can suddenly become extremely powerful. Higher option budget, which means more freedom in hedging, which means higher participation multipliers, which means greater amplification of index movement. This is why traditional indices are often used as the growth sleeve of an FIA allocation. Strategic use cases. Traditional indexing fits when clients want direct market responsiveness, long-term equity exposure, higher upside during strong bull cycles, allocations paired with multi-year point-to-point, allocations amplified by strategy charges, and a familiar index as part of their blend. Traditional exposure can be a strong component, but it requires the right structure to reach its potential. Engineered indices are fundamentally different. They were designed specifically to operate efficiently inside FIA mechanics. These indices typically include volatility control, multi-asset blends, tactical or momentum rules, risk targets, and adaptive signals. How engineered indexing behaves inside an FIA. Engineered indices maintain stable volatility, often targeting levels like 5% to 8%. As we clarified earlier, this is a risk target, not a return target. That stability dramatically reduces hedging cost, which allows the annuity to offer higher participation multipliers, more consistent crediting terms, and fewer zero-credit years. The strategic advantage of engineered indices. Engineered indices are not designed to beat traditional market benchmarks. They are designed to fit inside an FIA's crediting formula in a way that produces stable, creditable movement that the FIA can amplify. Engineered indices often serve as the foundation of an allocation because they pair well with 1-year or 2-year reset cycles. They offer strong participation efficiency. They smooth out downside volatility. They provide consistent input into the FIA crediting mechanism, and they reduce the behavioral stress of dry spells. Strategic use cases. Engineered indexing fits when clients want consistency, fewer zero-credit years, stable patterns, strong annual participation, efficient use of the option budget, and a reliable base allocation to diversify with traditional exposure. For many advisors, engineered indices form the core of their FIA strategy. The real distinction: responsiveness versus stability. The true difference between traditional and engineered indexing is not returns or safety or risk. It's responsiveness versus stability. Traditional equals responsive. Traditional indices respond directly to market surges and declines. They capture the raw movement of equities, the good, the bad, and the volatile. Engineered equals stable. Engineered indices generate smoother movement, not smaller movement. And that stability allows the FIA to buy more exposure through higher participation. Neither is inherently better. Both play important roles. Professionals select based on the client's objective, the reset cycle, and the market environment, not based on index popularity or branding. How professionals pair traditional and engineered. Real FIA allocation is rarely all one or all the other. Professionals combine the two because their return patterns operate in different regimes. Here's how pros think. Engineered index equals base sleeve. Stable, efficient, consistent. Works well annually. Provides the foundation of the allocation. Traditional index equals potential sleeve. Add-on exposure for multi-year cycles. Amplifies long-term equity trends. Pairs well with strategy charges or extended reset periods. Here are 3 examples of professional blends. 1. An engineered index on a 1-year reset paired with a traditional S&P index on a 5-year point-to-point. 2. 2 engineered indices with different rule sets paired with a momentum-driven engineered index. 3. A volatility-controlled index paired with a multi-year S&P sleeve for growth. Professionals diversify rule sets, not brands. How to decide between traditional and engineered for a given client. This is where indexing decisions become personalized. Choose engineered when the client wants stability, consistency, fewer zero-credit years, high annual participation, less sensitivity to market timing, and a smoother client experience. Choose traditional when the client wants potential for stronger long-term upside, more exposure to equity-like patterns, multi-year performance windows, amplification through strategy charges, a familiar benchmark, and a growth-oriented allocation. Choose both when the client wants balanced outcomes, diversification across return regimes, a combination of stability and potential, and tactical blending across reset cycles. Traditional and engineered are tools. The strategy is in how they're combined. Traditional indexing and engineered indexing are complementary strategies, not competing philosophies. Traditional indexing offers responsiveness. Engineered indexing offers stability. And the right blend depends on your goals, your time horizon, and the structure of your FIA. This is the first real decision point in selecting your indexing strategy, and the foundation for the deeper index design categories we'll break down next. Index design types. The internal architecture behind each indexing strategy. Now that we've covered the 2 indexing philosophies, traditional and engineered, the next step is to understand the design architecture inside those philosophies. Because not all engineered indices are the same, and not all traditional indices are the same. Each class of index behaves differently inside a FIA's crediting formula. There are 4 primary design types: single market indices, multi-asset indices, volatility-controlled indices, adaptive, momentum-driven, or AI-assisted indices. These are not competing products. They are different architectures, and each plays a different strategic role inside an FIA allocation. Let's break them down. Single market indices. Single market indices are the simplest design. A pure exposure to one underlying market. Think S&P 500, NASDAQ 100, Dow, and sector-specific indices. How they behave inside an FIA. These indices deliver the raw movement of the equity market, with all its volatility, clustering, and dispersion. Inside an FIA, they are expensive to hedge annually. The annuity often responds with lower participation rates or caps. They create more zero-credit years, but they can be extremely powerful with multi-year reset periods or strategy charges. When they shine, single market indices perform best in environments where equity trends persist for several years. Volatility is moderate to low. Crediting windows align with bull cycles. The client can tolerate more variability, and you can afford a multi-year point-to-point structure. They're ideal for the potential sleeve of an FIA. Multi-asset indices. Multi-asset indices take a more sophisticated approach. They blend equities, bonds, commodities, and sometimes global asset classes to create smoother paths. Why this matters inside an FIA. Different markets follow different regimes. U.S. equities, international equities, bonds, commodities, currencies. They don't move together. They have different volatility signatures, different drawdown depths, and different recovery cycles. When combined, these differences reduce correlation, smooth volatility, lower hedging cost, stabilize forward volatility, and allow the FIA to offer higher participation multipliers. This isn't about diversification for diversification's sake. It's about creating a stable return path that the FIA can amplify. The global advantage. Global markets often peak at different times, bottom at different times, move under different policy regimes, and experience volatility clusters that don't overlap. This naturally stabilizes the path of the index. For FIA crediting, that stability is gold. When multi-asset indices shine, annual resets, choppy or sideways markets, environments with cross-asset dispersion, clients who want stability and fewer zeros, and blends where you need a smooth base sleeve. Multi-asset indices often deliver some of the most consistent FIA crediting patterns, even if they underperform U.S. equities in raw markets. Volatility-Controlled Indices. This is one of the most important design classes inside modern FIAs. Volatility-controlled indices maintain a target volatility, often in the 5% to 8% range. How they work. When volatility rises, the index reduces exposure to risky assets. When volatility falls, the index increases exposure. The goal isn't to beat the market. It's to maintain a stable risk environment that the FIA can hedge efficiently. Why vol control works well inside FIAs. Stable volatility means lower option cost, which means higher participation. Annuity carriers prefer volatility-controlled indices because they can price them more predictably. They maintain hedging efficiency. They allow strong annual participation multipliers. They reduce the probability of a zero-credit year, and they help stabilize product terms during volatile markets. This is why volatility-controlled indices often become the default base allocation for many advisors. When they shine, clients who want consistency, shallow or choppy trend environments, annual or two-year point-to-point, behavioral risk management, and markets with unpredictable volatility swings. Volatility control indices form the spine of many professional FIA blends. Adaptive, momentum-based, and AI-driven indices. This is the cutting edge of FIA index design. These indices use rule sets, sometimes enhanced by machine learning techniques, to react dynamically to market conditions. What they actually do. They incorporate signals such as trend identification, regime detection, risk factor modeling, momentum confirmation, volatility forecasting, cross-asset rotation, macro overlays, and machine learning classification models. This isn't AI picking stocks. It's AI optimizing rule sets. Why this matters in a FIA. Adaptive indices can increase exposure when markets enter stable, trending phases, reduce exposure during hostile regimes, maintain smoother volatility than traditional equity, react more quickly than static volatility control, provide dynamic exposure without raw market volatility, and generate return paths that FIA crediting can amplify efficiently. These indices often provide a blend of responsiveness, traditional, stability, engineered, efficiency, volatility control, and adaptability, momentum, or AI. when they shine, trending markets up or down, turning points between market regimes, blends needing a tactical sleeve, clients wanting modern, data-driven approaches, and scenarios where traditional or static engineered indices lag. They should not replace other index types. They enhance them. How the index types fit together. Here's how these index architectures relate to each other and how they fit into a professional FIA allocation. Single market indices align with the traditional approach. Multi-asset indices fall under engineered designs. Volatility-controlled indices are also engineered. Adaptive and AI-driven indices are engineered as well. Traditional indexing is a single architecture, direct equity exposure. Engineered indexing contains multiple architectures, multi-asset, volatility control, and adaptive designs. Understanding this hierarchy makes allocation decisions far more intuitive. Matching design type to the client's goal. Goal: stability or fewer 0 years. Multi-asset or volatility control. Goal: consistent annual crediting. Volatility control. Goal: moderate growth with stability. Multi-asset. Goal: responsiveness to emerging trends. Adaptive momentum, AI. Goal: long-term potential. Single market with multi-year reset or charge. Goal: diversification across rule sets. 1 to 2 engineered indices plus a multi-year traditional sleeve. Goal: smooth overall experience. Heavier engineered blend. Goal: tactical opportunity. Adaptive index for regime response. Crediting mechanics. How FIA index options actually convert index movement into interest. Now that you understand the architecture behind the indices themselves, the next step is understanding how your annuity actually converts index performance into credited interest. Because choosing the right index is only half of the equation. The crediting method you pair with that index determines how efficiently positive movement is amplified, how much of a trend you can capture, how stable your long-term pattern will be, and ultimately how well your allocation aligns with your goals. There are 5 primary crediting structures we use in FIAs. Participation rates, caps, spreads, multi-year point-to-point, and strategy charges. Let's walk through what each of these actually does, how they behave in different markets, and when professionals use them. Participation rates, often called par rates, are the engine behind most modern FIA indexing strategies. A participation rate is simply a multiplier of the index's positive movement. If the index is positive, the FIA credits interest based on that multiplier. Here's a simple, neutral example. If a strategy offers a 300% participation rate and the index rises 6% over the crediting period, the FIA would credit 18%. Participation rates do not reduce negative years. They simply amplify positive ones. Why participation rates are central to FIA growth. Participation is directly tied to option budget efficiency. Smooth, low volatility indices cost less to hedge. Lower hedging cost means higher participation. Higher participation means more amplified upside. This is why engineered indices, multi-asset, volatility control, and adaptive, often show 150%, 200%, 250%, and even 300% plus participation multipliers. Participation rates shine when the index has stable, predictable movement. The goal is consistent long-term growth. The client prefers fewer big swings, and annual or 2-year crediting windows are being used. Professionally speaking, par rates are the default choice for engineered index designs. Cap rates. A cap sets an upper boundary on how much interest a strategy can credit. Caps are most common on traditional single-market indices, like a 1-year S&P 500, point-to-point. A clean example. If your S&P strategy has an 11% cap and the index rises 14% during that year, your credited interest would be limited to 11%. Where caps work well. Caps perform well when market returns are in the high single-digit or low double-digit range. Volatility is moderate. The index rarely exceeds the cap. The client is comfortable with a simpler structure. Where caps struggle. Caps are less effective when markets produce strong breakouts. Volatility swings reduce hedging efficiency. Or you want higher long-term potential. Professionals typically use caps as a simplicity tool, not a growth tool. Spread-based strategies. A spread deducts a fixed amount from the index's positive gain. Neutral example. If the index gains 10% and the strategy uses a 5% spread, the credited interest would be 5%. When spreads are useful, spreads often appear when par rates would be too low to be attractive. Caps would overlimit the upside. The index produces steady, persistent upward movement, or the volatility regime is favorable. When spreads perform best, here's the nuance professionals understand. Spreads can outperform caps, and in some market patterns, even multi-year structures. When markets deliver steady above-trend gains over multiple reset periods, volatility is muted, and the index is trend-following or engineered. Spreads are not a penalty structure. They are a different formula that works best in persistent upward environments. Multi-year point-to-point, 2, 3, 5, 7-year. Multi-year crediting is one of the most powerful levers inside FIAs. What multi-year actually does? It extends the hedging window. It increases the total option budget. It reduces the impact of short-term volatility. It raises participation multipliers. It aligns with longer performance cycles. In practice, the longer the crediting window, the more efficiently the carrier can hedge the index, which often results in higher participation rates. Where multi-year shines. Multi-year structures shine when the client wants higher long-term potential. They're comfortable with less frequent lock-ins. The index behaves in cycles rather than annual bursts. Strategy charges are being used. Traditional indices are being used, and the time horizon is long enough to absorb variance. Multi-year engineered, a major growth driver. This is one of the most overlooked ideas in FIA allocation. Engineered indices are already stable. Multi-year windows further reduce hedging cost and expand the option budget. This combination often results in very high participation multipliers, amplified exposure during strong years, and some of the highest potential crediting outcomes in any FIA structure. When a multi-year engineered index captures a strong global or trend-driven year during its reset cycle, the amplification can be dramatic. Professionals often include multi-year engineered indices as part of a max growth sleeve. Strategy charges, fee-based index strategies. Strategy charges are one of the most misunderstood crediting tools in FIAs, and one of the most powerful. A strategy charge increases the option budget. More budget means more index exposure, means higher participation multipliers. Example: a strategy might offer a 180% participation rate with no charge. With a 1.25% strategy charge, the same index might offer something like 240% participation. This has nothing to do with predicting returns. This is simple engineering. The charge gives the carrier more budget to buy more index exposure. Where strategy charges shine. Multi-year crediting. Traditional indices. Engineered indices with already strong participation profiles. Adaptive indices. Any allocation aiming for maximum long-term growth. What risk they introduce. If the index is negative for the period, your credited interest would be minus 1.25% or whatever the charge was, instead of 0%. This is why charges must match the client's time horizon, tolerance, growth objectives, and professional insight. If the goal is maximum long-term potential, strategy charges are not supplemental. They're central. Over long horizons, the amplified exposure often outweighs the occasional negative charge year. How index types pair with crediting methods. Different index architectures naturally align with certain crediting structures. This framework helps simplify the pairing process. Engineered indices pair best with participation-based crediting. Strong synergy with stable volatility and efficient hedging. Multi-asset indices pair best with participation-based crediting. Stable movement means high participation, means consistent long-term behavior. Volatility-controlled indices pair best with participation-based crediting. Volatility targeting directly supports strong participation profiles. Adaptive, momentum, AI indices pair well with participation for annual resets and multi-year structures when available, amplifies long trends and regime captures. Traditional single-market indices pair best with multi-year crediting. More budget means higher participation, means better use of equity trend cycles. and strategy charges expand the option budget for greater upside potential. Aligning crediting designs with client objectives. Choosing a crediting method isn't about formulas or rigid combinations. It's about aligning the behavior of a crediting design with the experience the client wants. Here's how professionals think through it. Objective, stability, and consistency. Choose structures that deliver smooth, predictable cycles. Engineered indices with annual crediting. Clean, steady behavior with strong participation terms. Multi-asset or volatility-controlled indices. Designed to avoid long stretches of zero credit years. These combinations minimize surprises and provide the most reliable year-to-year experience. Objective, moderate long-term growth. Blend stability with measured opportunity. Engineered indices with annual participation. Efficient growth in mixed markets. Engineered indices with multi-year crediting. Higher potential during stable cycles. Adaptive AI-driven rule sets. Capture emerging trends without raw market volatility. This creates disciplined, upward-biased performance even when markets vary. Objective, maximum long-term potential. Use structures that maximize the option budget and amplify long performance cycles. Traditional indices in multi-year crediting windows. High amplification when long cycles develop. Engineered indices in multi-year crediting. Exceptionally strong participation multipliers. Any index paired with a strategy charge. Charges expand the option budget, essential for max growth allocation design. In maximum growth strategies, amplification is the priority, and strategy charges are the architecture that makes amplification possible. Objective, behavioral comfort and simplicity. Choose crediting structures that feel intuitive and easy to follow. Engineered indices with clean annual participation. Simple, familiar index structures with conservative terms. These options reduce overwhelm and keep the experience straightforward. Objective, tactical or trend-responsive exposure. Use structures designed to adapt. Adaptive and momentum-driven indices. Adaptive indices paired with multi-year windows, when available. These excel when markets shift regimes or form new trends. We've covered the architecture of indices, and we've covered the mechanics of how interest is credited. Now we bring it all together. In this section, I'm going to walk you through a 4-step decision framework that professionals use to decide how to allocate inside an FIA. This is how to choose the right indexing strategy inside the annuity you already like. And when you follow this approach, the entire process becomes clear, structured, and aligned with the experience you want your retirement money to have. Let's begin. Step 1. Clarify your objective. Before you look at a single index or participation rate, the first question is, what type of growth experience do I want this money to have? Different people genuinely want different things, and that's why FIAs offer different designs. There are 4 legitimate objectives. Objective 1, stability and consistency. Some people want a growth path that's calm and steady. They don't care about capturing every big market move. They care about reliability. For these people, the priority is smooth index movement, stable participation, fewer surprises. This usually aligns with engineered index designs. Multi-asset, volatility-controlled, trend-adaptive. Objective 2, moderate long-term growth. These clients want stronger upside than pure stability, but they still want a design that behaves well in mixed market environments. Think of this as growth with discipline, often aligned with multi-asset engineered indices, adaptive indices, higher participation annual structures. Objective 3, maximum long-term potential. Some clients want the highest possible long-term upside the FIA can offer. They understand the trade-offs. Fewer lock-ins, more timing variability, greater sensitivity to cycles. But for them, long-term potential outweighs year-to-year consistency. This aligns with traditional indices plus multi-year structures plus strategy charges, and multi-year engineered indices with very high participation multipliers. Objective 4, behavioral comfort and simplicity. Not everyone wants complexity, even if the complexity leads to better outcomes. Some clients want familiar indices, clean designs, predictable resets, and simple crediting. This aligns with engineered participation-based designs or straightforward cap structures. Step 1 summary. You're not choosing an index. You're choosing a growth experience. Once you know that, everything else falls into place. Step 2. Choose your index architecture lane. Now that you know your objective, you choose which type of index design best supports it. There are 3 lanes, 2 index types, and 1 measurement style. Lane 1, traditional or single market. This is the S&P style lane. Characteristics: most responsive to market cycles. Strong raw long-term performance. Higher volatility, higher hedging cost. Often paired with multi-year structures, strategy charges, supplemental engineered sleeves, and are best for clients who want potential, not consistency. Lane 2, engineered or rule-based. This includes multi-asset indices, global blends, volatility-controlled designs, and adaptive strategies. Characteristics: smoother movement, better risk efficiency, lower hedging cost, higher participation multipliers, consistent performance across mixed or volatile markets. This lane supports stability, moderate growth, and disciplined long-term behavior. Lane 3, multi-year credit cycles. This is not an index, it's a timing structure. A multi-year cycle measures performance over 2, 3, 5, or 7 years instead of annually. Why use it? Longer window means larger option budget. Larger budget means higher participation multipliers. Less noise, more sensitivity to long-term cycles. Multi-year structures pair extremely well with both traditional and engineered indices, and they are especially powerful in max growth allocations. Step 2 summary. Traditional equals responsiveness and cycles. Engineered equals stability and efficiency. Multi-year equals amplified potential. Choosing the lane is choosing the engine for your strategy. Step 3. Choose the crediting methods. Now that you know your objective and index lane, you select the crediting structure that matches your priorities. This is where allocation becomes strategic. If the goal is stability and consistency, use structures that behave predictably. Engineered, multi-asset, or adaptive plus participation rate. These deliver the smoothest combination of movement plus amplification. If the goal is moderate long-term growth, blend consistency with opportunity. Engineered, multi-asset, or adaptive plus participation rate with a blend of multi-year. If the goal is maximum long-term potential, this is where structure matters more than timing. The strongest combinations: traditional plus multi-year plus strategy charge, or engineered plus multi-year plus strategy charge, or a blend of traditional and engineered plus multi-year plus strategy charge. These maximize the option budget and amplify long cycles. If simplicity is the priority, use clean engineered indices with simple participation or occasional cap structures on familiar indices. Step 3 summary. Crediting methods determine how much of the index the FIA can actually capture. This step is where the strategy becomes real. Step 4. Build your allocation blend. Now you combine index types and crediting methods into a cohesive allocation. Professionals rarely allocate 100% to a single index. Why? Because you're not diversifying markets. You're diversifying rules. Different rules behave differently under different conditions. A blend smooths that out. Conservative blend, stability first. For clients who want calm, predictable behavior. 60 to 80% engineered plus participation. 20 to 40% adaptive or multi-year engineered. This minimizes volatility and avoids surprises. Moderate blend, balanced growth. For clients who want a mix of stability and cycle exposure. 40 to 60% engineered plus participation. 20 to 30% multi-year engineered. 10 to 30% traditional multi-year or charge-based index. This captures both consistency and long-term potential. Aggressive blend, maximum long-term potential. This blend is designed for clients who prioritize the highest long-term upside and can tolerate timing variability. Every sleeve in a max growth allocation typically uses strategies with charges because the strategy charge expands the option budget. A larger option budget increases participation multipliers. Without charges, you cannot reach true max growth amplification. The blend includes traditional indices using multi-year crediting with strategy charges. Highest amplification of major cycles. Engineered indices using multi-year crediting with strategy charges. Extremely high par multipliers paired with global rule-based stability. Adaptive or momentum-based indices with strategy charges. Amplified exposure when strong trends develop. This is the purest long-term growth architecture available inside FIAs. Step 4 Summary. Your allocation blend is the expression of your objective, your index architecture, your crediting methods, and it becomes the actual day-to-day behavior of your annuity. Now that you understand the 4-step framework, your objective, your index lane, your crediting method, and your allocation blend, the next step is seeing how these choices behave across different market environments. Not hypothetical returns, not back-tested projections, just pattern behavior across volatile years, sideways years, strong bull cycles, global divergence, rising rate environments, and regime shifts. That's what we'll explore in the next section. How indexing strategies behave across different market environments. Now that you understand the structure of different indices, their crediting mechanics, and how to build an allocation, the next question becomes, what actually happens when these strategies run through real market conditions? This is one of the most important concepts to understand when choosing your allocation. Let's walk through 6 real-world market environments and explore how each indexing style tends to behave. Environment number 1, high-volatility years. Think of a year with sharp swings, corrections, short rallies, and a lot of uncertainty. Traditional single-market annual reset. Highly sensitive to volatility. Many near-zero credit periods. Caps or spreads often underperform. Input is choppy, so crediting is inconsistent. Traditional plus multi-year. Much more efficient. Multi-year cycle absorbs short-term noise. Participation multipliers help capture partial recoveries. Still more volatile, but structurally stronger. Engineered indices, multi-asset, volatility control, adaptive. This is their home field. Smooth movement, stable participation-driven credit. Far fewer zero credit periods. Significantly better hedging efficiency. Strategies with charges. Occasional small negative years from the strategy charge, but still efficient when the index produces any positive cycles. Amplification works well even in volatile conditions. Key takeaway. Volatile years reward stability. Engineered indices and multi-year structures tend to behave the most predictably. Environment number 2, sideways or flat markets. This is a year where markets drift, oscillate, and never really go anywhere. Traditional one-year structures struggle in this environment with many zero credit periods. Caps are rarely triggered due to not enough sustained movement. Traditional plus multi-year can capture slight upward drift. Long windows smooths out noise. Still dependent on full cycle outcomes. Engineered participation-based structures are often the most reliable performer here. They are designed to smooth choppy input and produce small but consistent positive credits and avoid prolonged 0 years. Strategy charges are still viable. They amplify modest positive cycles but must be paired with stable index architecture. Key takeaway. Sideways markets reward multi-asset and engineered indices that grind upward even when the market doesn't. Environment number 3, strong bull cycles. This is a sustained rally, multiple strong years with declining volatility. Traditional plus multi-year. Extremely powerful. Long windows capture full-length cycles. Participation rates capture large gains. One of the strongest combinations available. Strategy charges on any index type. Strategy charge budgets amplify upside. Small negative charge years are negligible across long bull cycles. Engineered indices. Still productive. High par rates provide steady participation. May lag slightly behind explosive single market rallies. Engineered multi-year. Can produce very strong amplified results. Extremely high participation multipliers. Less volatility drag than traditional indices. Key takeaway. Bull cycles reward long cycle structures, strategy charges, and both traditional and multi-year engineered designs. Environment number 4, global divergence. This is a year where U.S. markets are flat or struggling, but international markets or other asset classes are strong, or vice versa. Engineered global multi-asset indices. Top performers in this environment. Diversification across regions and assets. Lower correlation drag. More stable return pattern. Traditional U.S.-only indices, dependent on one region, may produce consecutive zero credit periods. Adaptive rule-based indices. Identify stronger global regions, shift exposure accordingly, and capture non-US opportunities. Multi-year structures. Capture global multi-year cycles and are not dependent on one-year domestic timing. Key takeaway. Divergent global markets reward global exposure, adaptive allocation rules, and multi-asset diversification. Environment number 5. Rising rates or economic stress. This includes rate hikes, recession fears, tightening conditions, and slowing growth. Traditional indices. Volatile. Unpredictable. Higher hedging cost means lower caps and participation rates. Engineered designs. Maintain structural stability, reduce drawdown impact, and can produce incremental positive periods. Adaptive indices. Shift toward lower volatility assets. Avoid prolonged negative trends and preserve hedging efficiency. Multi-year traditional and engineered. Absorb shorter-term stress. Capture recovery periods when they occur. Remain efficient even in messy markets. Key takeaway. Rising rate environments reward stable, rule-based index designs and multi-year hedging windows. Environment number 6. Mixed or regime shift years. Years with both bull and bear phases, mid-year reversals, and major turning points. Traditional annual structures. Highly dependent on reset date timing. Randomness plays a large role. Many cliff effects. Traditional plus multi-year. Smooths out timing randomness. Captures full cycle outcome. More predictable long-term behavior. Engineered participation structures. Absorb regime transitions smoothly. Avoid violent swings. Maintain crediting consistency. Adaptive indices detect regime shifts early, rebalance within rules, and provide smoother corrections. Key takeaway. Regime shifts reward adaptive, smooth, and multi-year structures over short-cycle traditional designs. The lesson across all 6 environments is simple. Different indexing rules behave differently depending on the environment. There is no best index. Only the index rules that match the experience you want your money to have. Some designs excel in volatility. Some excel in bull cycles. Some excel in divergence. Some excel in regime shifts. And that's why blending index types, diversifying the rules, not the market, is so powerful inside a fixed indexed annuity. Let's pull everything together into a clean, structured summary you can actually use when choosing your indexing blend. First, index architecture. You now understand the difference between traditional indices, which follow a single market, engineered and multi-asset indices, designed to stabilize movement, adaptive and global rule sets, which respond to changing conditions, and why the rules inside an index often matter more than the name printed on the brochure. Second, crediting mechanics. We clarified how participation rates, caps, spreads, multi-year cycles, and strategy charges convert index movement into credited interest. Each crediting structure behaves differently, and now you can match those mechanics to the type of performance experience you want. Third, the 4-step decision framework. We structured the decision-making process into 4 clean steps. Clarify your objective. Choose your index lane. Select your crediting method. Build your allocation blend. This turns a long menu of options into a disciplined, professional selection process. Fourth, market environment behavior. We looked at how different indexing rules behave in high volatility periods, sideways or flat markets, multi-year bull cycles, global divergence, rate-driven environments, and regime shifts. Each index design shines in different scenarios, which is why blending rules, not markets, is so powerful inside a fixed indexed annuity. Indexing inside an FIA can look complicated from the outside, but once you understand the structure, it becomes logical, intentional, and aligned with the experience you want your retirement assets to have. You don't need to pick a perfect allocation on day one. You can adjust choices each year or each credit cycle. The goal is alignment, not perfection. And if you'd ever like help applying this framework to your own situation, our team can walk you through it calmly and step by step. No pressure, no urgency, just clear, independent guidance designed around your goals. Thank you for spending this time with me. This video is the first installment in our FIA Masterclass series. We'll continue releasing more deep dive content on annuity design, indexing strategy, and retirement income structure. And if you'd like to follow along, feel free to subscribe. Thanks for watching, and I'll see you in the next masterclass.